Hey there, welcome. Have you ever stopped to think about the real size of the world economy? It seems like it should be a simple question, right? But the answer, well, the answer reveals something fascinating about how we measure our world. So let's dive right in. It really all kicks off with a kind of puzzle. How is it possible that one single question about the global economy can lead to two completely different, and yet somehow equally correct, answers? And that question is this. Right now, today, which economy is bigger, the United States or China? I mean, you'd think there'd be just one straightforward answer to that, wouldn't you? But here's where it gets interesting. If you measure things using market exchange rates, the numbers you see flashing on the news, the US economy comes out on top. But if you measure using this other thing called purchasing power, China's economy is actually bigger. So what's going on here? How can both be right? Well, to get our heads around this, we've got to zoom in a bit. Let's talk about the famous Big Mac test. And believe it or not, it's a fantastic way to understand what money is really worth. Not just on some financial market, but in your pocket, in your everyday life. What we're really talking about here is purchasing power parity, or PPP for short. Now, the official definition is the exchange rate you'd need to buy the exact same basket of goods and services in two different countries. Okay, that's a mouthful. So what does it really mean? It's all about what your money can actually buy. To make this crystal clear, let's just park the idea of trillions of dollars of GDP for a minute and focus on one simple, universal thing, a hamburger. Okay, so look at this. The logic here is actually super simple. If a hamburger costs $4 in New York and that exact same hamburger costs £2 in London, then for the purpose of buying hamburgers, $2 has the same buying power as £1. See? The implied PPP rate is 1 to 2, and that rate might be totally different from the one you'd see at a bank. So there you have it. We've got two different yardsticks, market rates and PPP rates. And choosing the right one, well, that depends entirely on what kind of story you're trying to tell. On one hand, market exchange rates are perfect for tracking financial flows. Big money zipping between countries for trade and investment. But on the other hand, PPP rates are so much better for comparing the actual standard of living. That's because market rates can be really volatile and mostly reflect goods that are traded internationally. PPP is more stable, and it includes all those local services, like a haircut, which can be way cheaper in lower-income countries. Okay, but how in the world do you calculate this for an entire economy, not just hamburgers and haircuts? Well, it takes a truly monumental global effort. This massive price check is run by something called the International Comparison Program, or ICP. It's this huge statistical project managed by the World Bank, all designed to figure out these incredibly important PPP numbers. And the scale of this thing is just mind-blowing. To get these numbers, the ICP tracks the national average prices for over 1,000 specific products and services in every single country that takes part. It's basically a price list for the entire planet. So their whole mission is pretty straightforward. First, produce the PPPs we've been talking about. Second, create indexes so you can compare price levels across countries. And third, use all that to convert GDP into a common currency so we can finally make real apples-to-apples comparisons of economic output. And this is where it all comes together. This isn't just some academic exercise for economists. No way. These numbers are absolutely essential for understanding some of the most important human stories on our planet. Take this, for example. The World Bank points out that PPPs are critical for setting the international poverty line. I mean, think about it. To know if someone is really living on less than, say, $2 a day, you have to know what $2 can actually buy where they live. And it doesn't stop there. The United Nations uses this same data to figure out the real cost of a healthy diet around the world. It helps answer a vital question. Can people actually afford to eat nutritious food, no matter where they are? Which brings us right back to where we started. Just look at this chart. It tells the whole story. When you use PPP, the economic weight of huge developing countries like China and India gets way bigger. It gives us a much more accurate picture of their real on-the-ground contribution to the global economy. So now you've got this new economic lens. The question is, how do you use it? Let's break down when PPP is the right tool to pull out of your toolkit. Okay, here's a quick guide. PPP is your go-to for looking at long-term currency value, for comparing what real incomes look like, and for figuring out how competitive economies are. But, and this is a big but, it's absolutely the wrong tool for trying to do short-term currency trading or, predicting the next financial crisis. Those things are driven by fast-moving capital flows, not the price of a hamburger. So if you remember one thing from all this, make it this. Think of purchasing power parity as a long-term anchor. It grounds our understanding of an economy's real, productive value over years, even decades, and it separates that from all the daily noise of the financial markets. Which leaves us with one last big question to think about. As technology and global trade keep changing the price of everything, from software to shipping, how is this PPP-adjusted picture of our world going to shift in the next 10 years? It's a question that's going to define the next chapter of the global economy.